good evening, and thank you for joining us from Singapore and Hong Kong. And thank you for joining early. So we'll wait for maybe just a little bit more for a few more people to join. But in the meantime, I think for this session, the plan is just to get to the topic, but also to take any of your questions that you may have. And we've deliberately kept the slide portion of today's session relatively short in comparison to what we've done in the past, just to leave more time for Q&A. So please use the Q&A icon and input your questions as we go along. If any of the slides have a question, please just feel free to do it earlier on. You don't have to wait till the end when we get to Q&A. Right, I think we can start now then. Okay, could we go to the agenda slide, please? All right, so today, we'll have a very quick introduction to SAIF, and followed by, going into the topic, how did we get here, in a year where both equities and bonds have fallen, and to show, in the context of historical time periods where we have seen such a scenario, what happens next. So, and then also going into what are the reasons for this. And then we'll go into a quick fireside chat component, and then of course want to leave a lot of time for Q&A. Before we get started, we do have 2 poll questions. If you wouldn't mind pulling it up, Jason. Okay, so these 2 are together. I think I'm just quite curious to see, what's the allocation of what most people have who are on the webinar with us today. So the first one is, what would you say is closest to your, asset allocation? Would you say it's, you're close to 100% equities and 0% bonds versus, kind of going down that threshold? And then the second question, similarly, right, do you hold anything else besides equities and bonds, right? I think most people went real estate, do you have crypto, or so do you, have cash, or is it collectibles, right? So like luxury watches, yeah, and any of that. Okay, if we have enough responses, let's see if we can see some results. Okay. Right, yeah, so it still seems relatively equity heavy for most of the respondents. And yeah, cash and real estate are the most popular, but of course, crypto, I think, we do expect roughly like 10% to 15% of people who do have some crypto exposure. All right, thank you everyone for answering. We'll come back to these results too as we go along, but in the next slide, just want to quickly introduce ourselves. So I'm Grace, and I lead investment research at SAIF. So before joining, I spent most of my time in fixed income. So doing sell-side research, as well as being a product specialist at Franklin. And then moving on to Ritesh.
Hello. Hi, everyone. I'm Ritesh. I head the investment advisory team at SAIF, also looking at the investment team right now. Been with SAIF for more than 3 years since its inception. So, again, very excited to share what we have today for everyone. And it's a tough environment, so hopefully we should have some insightful ideas coming through.
Hello, it's Winnie here. So I'm from SAIF Hong Kong. Before joining SAIF, I was in hedge fund for a decade. So the last role before joining here is a portfolio manager in hedge fund, being more familiar with the US and China equities.
All right. Okay, maybe I'll quick start with a quick introduction to SAIF. I hope most of the people who have joined in are existing clients, so you would obviously know about SAIF very, very well. But there will be some who are joining this webinar for the first time. So in their interest, just a quick introduction. So SAIF is a digital investment platform. We are headquartered in Singapore, and we are building the next generation of investment solutions for individuals across Asia. In terms of our platform, we have a one-stop platform. So if you go on to the next slide, which caters to all of your investment needs, from fully managed portfolios for long-term wealth building, as well as a digital brokerage platform for fractional access to the US stock market and ETF market as well. Across Singapore, Hong Kong, and Australia, so now we are in 3 different locations, our mission is to break down the barriers of investing by providing simple, smart, yet affordable financial solutions and help people attain better outcomes in life. 2022 has been a pretty phenomenal year for SAIF. So if you go on to the next slide, it kind of maps out our journey so far. As you can see, we have, grown quite substantially over the last 3 years, but more importantly, 2022 is when we have gone and become a truly, regional player. It's expanding into international markets such as Hong Kong and Australia. So we also have Vinny today joining us from Hong Kong. Earlier this week, we also celebrated our 3rd anniversary, right? So it's been a 3-year plus journey for us at SAIF headquartered, started off our, investment solutions from Singapore. And we also reached a very important milestone of over 100,000 clients in Singapore alone, right? So thank you everyone for the support, people who are already clients of SAIF. Thank you so much for the support so far. And hopefully, again, the market's been tough, environment is tough, but as we move along, we hope to bring you more, smarter solutions and advice as well, and guidance. How do you navigate through these situations in a much more better manner? All right, so with that, we will move on to the next section. I will hand it over to Grace.
Yeah, thank you, Ritesh. All right, so I think most of you would know that today, or rather in a few hours, we'll get the latest FOMC rate decision, right? And also hear from the committee on how they view their twin objectives of full employment or maximizing employment in the US economy and also maintaining price stability. And I think most of people also know that, there will be minutes that are released 3 weeks after, but actually, like what I really like to look into or sort of like to view right after the meeting is that there will be a press release, and that's also a press conference. And in that press conference, like Jerome Powell takes questions from reporters, and generally, like the language there and the content there is very digestible, right? Sort of reporters asking him, what does he think is going to happen, right? Does he think that the economy is going to go into recession, right? How close are they to being done with rate hikes? So yeah, I mean, if you're interested, I think, that's a great resource. So you can view it and also read the transcript. But if you want to go into sort of the meat of the topic today, and that's trying to show that, sorry, the next slide, please. Right, the 60-40 portfolio, right? It's been a very classic portfolio that most people sort of refer to as sort of a point of comparison, right? That like because it's thought of that the 60-40 portfolio of stocks and bonds, right? If you just look at the US only, that has gained like double digits, so about 11.5% since the Great Financial Crisis, right? But in 2022, it's been quite challenging. So if you look into this in this slide, it's been down close to 20% since the start of the year. Right, so this prompts the question, right? Is this 60-40 portfolio still relevant? Is that still what people should have if they want to have that sort of more balanced allocation? But if you do go back to, in the last about 40 years, right? So a double-digit decline in 60-40 is not really unheard of. But what's unusual is that for most of the years, right? So if you see the gray bars and the green bars, is that for most of the years, you either have them both being positive, or you have one being positive and the other being negative. And that's the negative correlation, right? That you see here, where adding bonds to an equity portfolio gives you some diversification and downside protection. But in 2022, you see that both the green bar and the gray bar, they're both negative, right? So like anything that has sort of happened in the past where you have that negative correlation where one goes up and the while the other goes down, like that has not happened. So yeah, I mean, what has happened so far, and it's quite strange. So the next few slides we'll drill into that. But the current macroeconomic and policy backdrop does raise some questions about, like for multi-asset investors, right? Like if you're trying to like balance out the potential of equities, but also the volatility using bonds, right? Is this what we should, is 60-40 still relevant for our portfolio? And for a bit of context, for SAIF portfolios, if you have any of our SAIF core growth or core balanced, similar to what the rest of the markets have done. It's also down about double digits, but slightly lesser than the sort of traditional like 60-40 that's benchmarked to like global indices. So if that's down about 18%, until August, we're down about 14%. Just a bit of context. All right, so the next slide, coming at it from a different angle and going back 100 years, so back to 1929, so almost 100 years, that's only been about 4 years, right? Where the 3 full calendar years in this year to date, where bonds did not go up when stocks went down. Right, so in 1930s, we saw a currency crisis, which, the UK abandoned the gold standard in the 40s. It was because of the war. So that's, quite unusual. But in the 70s, I think this is maybe more relevant to what's happening today. And in that period, right, there was a combination of factors. Before that, there was like government spending, there was loose monetary policy. And then what's happening like geopolitically, there was an oil crisis that led to like a decade of higher inflation, right? So some of these factors do sound somewhat familiar to what we've experienced so far in 2022. And these factors, we'll see how that has affected asset returns this year. Right, so I think most of you already know on the next slide, like stocks and bonds tend to go in the same direction during periods of heightened inflationary concerns, right? So I think for bonds, perhaps if we just talk about the transmission mechanism a bit, so the role of a bond, right, is to produce a steady stream of income and still, potentially give you a bit of offset against equity volatility. Right? So this is still true now, and it has been in the past. But when interest rates rise, right? So for example, last time, maybe like a year ago, you could be buying a bond and then you get 2% of coupon every year. But now that the interest rates have gone up, let's say, for a same bond that is issued by the same company or the same country, right? You're now getting maybe 4% in coupon. And what does that mean for the bond that you used to hold in the past? So that becomes a lot less valuable, right? For someone who's like going out and trying to buy a bond and taking roughly the same amount of risk, they're like, okay, right, why would I pick the one that only pays me 2% in coupon versus 4%? So the older bonds, in a way, lose a lot of value. So that's also why you see that in the price return of a bond. And then for equities, I think this is generally quite well understood and also quite, we've all experienced it. And it's because of the higher interest rates due to the Fed trying to fight inflation, then that affects the discount rate, right? So your future earnings and your future growth of these companies are worth a lot less than they were before, right? Because you're sort of applying a higher discount rate to that. And then if we could go to the next slide of, right, we like to think of, just interest rates or real interest rates, right, which is the nominal interest rate taking away inflation. It's a bit like a speed bump, right? So if it's too high, then all the cars in the road that's going a bit too slowly, it causes a traffic standstill, and in the words of the Fed, right? So that might cause enough of a slowdown to be like a recession. So nothing really moves, or ultimately interest rates should be sort of high enough to slow it down, right? To slow cars down, to slow the economy down, and to bring that price instability down. Right. So a few weeks ago, the market thought that inflation has peaked, and then we had the Jackson Hole speech in August. It didn't really help, and then the latest August inflation report that also kind of put a dampener to those hopes that inflation has peaked. And I think that was last week, and that shaved about 4 to 5% from US equity indices in just a day. Right. So the near-term outlook for inflation is not rosy, right? Despite there's been like short bursts of optimism and data points and evidence that like oil prices and food inflation is trending downwards, and like supply chain disruptions are easing somewhat. But because inflation is calculated on a 12-month basis, right? So for the rest of the year, you'll get September 2022, and then you drop September 2021, and so on. So assuming that even if inflations for the next 4 months, right, September, October, November, December, even if they're coming in lower in the 4 months, they're exiting the index, right? So you have the last 4 months, 2021, right? So mathematically, because of you're still taking an average, right? Or average like the 12-month kind of growth. Right, so you still sort of see inflation in the mid to high single digits. So even though the Fed is doing what they can using interest rates to bring down inflation, it will take some time for that to show up in the data. So in this chart specifically, we see the Fed funds rate, right? This is the upper bound. So Fed funds rate tends to be quoted on a range of like 2.25 to 2.50. So when it's plotted, we tend to just take 1 point, the lower bound or the upper bound or the midpoint. So here we take the upper bound, and compared to the last 40 years, despite a very rapid ascent very recently, the rate is still relatively low compared to historical periods, despite inflation being an all-time high. Right, so this could mean that rates still have some way to go, and also that the Fed might have to keep rates higher for a longer period of time before they see consistent evidence that inflation or just price instability is dampening. Right, but however, right, in the gray shaded periods, right, see that the interest rates do not stay at peak for very long. And currently, increased interest rates have raised recessionary fears. And compared to when we first had some of these webinars in 2022 at the beginning of it, like I think a lot of that centered around inflationary fears, but now that has shifted into recessions and the fear that the cure could be worse than the disease. Okay, let's have one more slide on the kind of macroeconomic outlook for the US, and that's looking at, as we sort of think of inflation into recession, I think it's not a surprise that, a lot of these recessionary indicators or business activities, they are trending downwards, but they're not exactly falling off a cliff, right? As you've seen in like the last few rounds of rather deep recessions so far, which is positive. And also like studying, in the past, like when we've had recessions, but heading into those recessions with a very strong labor market, they tend to be relatively shorter and more mild. And then if you look at the column chart on the right, and it's that in the US, about 2/3 of the economy is made up of consumption and consumer spending, right? Given that how high inflation has been and the shift from goods to services, consumer spending, despite a deterioration in sentiment, consumer spending is still relatively high. And that helps to kind of create the environment for a milder and hopefully relatively shorter recession as well. Right. So in the next section, we'll go into what can investors do, right? In terms of do they still think of bonds as a buffer? What happens next in historical scenarios where we've seen such a sell-off in equity markets? Okay, so for the first slide that we have, this illustrates that bonds are just inherently less risky because owners get their cash flow. They have more certainty about their cash flow, and they also have more certainty about receiving a given value at maturity, right? So as compared to stocks, which have unlimited upside technically, bonds have very limited upside relatively. So the value tends to be just ascribe more, certainty to that. And so, you see that in the data as well. So since 1926, also going back to almost 100 years, right? So stocks have had more quarters of negative returns, and the drawdown, so the magnitude of losses for bonds is typically also less. Right, and I know we've seen, positive correlation to equities very recently. If we do sort of zoom out a bit and think of a longer time period, right, bonds can still provide diversification benefits. And even during periods of rising interest rates, they still have a lower correlation to stocks than other major asset classes. So this still enhances the ability to reduce risk at the portfolio level. And now that interest rates are rising, you also have more of that buffer, right? So if you think of total return as price return and income return, which comes from a coupon, then if you have a higher coupon, right, that sort of insulates you a bit from, a bit more from any price deterioration because of interest rate hikes. All right, in the next slide, so this chart, I think is quite interesting because it shows times when consumer sentiment is very low, right? So any of these points where it's close to the bottom, right, like February 1975, and then March 2003. So anything that's below that average blue line, it just shows that when consumer sentiment has been the lowest, right? And then what were the subsequent 12 months performance of the S&P 500. And if you take all those blue points in the past, right, so there were 8 of them, and for those times, the subsequent 12-month S&P returns were almost 25%, right? So for this time, of course, it's still, we don't know, but we know that consumer sentiment is very, very low. It's even lower than it's been in the 80s right now. And it's hard to say like whether it has hit the bottom. But if you think of just looking at what happened in the past, it's almost like the saying, right? It's darkest before the dawn, where people are feeling like very depressed when the valuations have come down, where sort of, you do have that a bit of extreme risk off sentiment in the next 12 months. And also, I guess, longer term that you'll see in the next slide is that overall markets tend to go up. And the reason for that, which we'll cover a bit in the next slide, is that, I think overall, like corporations and companies are just much better at turning like capital into profit, right? So if you think of what actually drives earnings and stock returns, and that what drives stock returns, and that comes down to companies' earnings. So as long as companies are able to be innovative, to sort of keep that pricing power, and to just increase the revenue, and to sort of just keep earning, you do see that over time, right, stock markets tend to go up over the long run. So just the last slide, showing $1 invested since the 1870s, right? So from time to time, right, stock markets go through long and deep periods of decline, right? So these are the sort of parts that have a line across them, and then it shows that they've been in negative territory from when that the start of that period. So after a large decline, right, it's always difficult to predict how long it would take markets to recover. But over the very, very long run, and I mean, this goes out to 100 years, but you sort of can see that even like a 10-year period, stock markets have been generous to investors who can get through long periods of decline, right? And during these times of sort of a deep, and I think so far it's been a relatively rapid decline, right? I think investors, if they can avoid panic selling, you do see that to history as any guide, right? Like prudent long-term investors who can withstand the risks of investing, is sort of like have their have a plan, they stick to it, right? It does pay off in the long run. Right, I will now hand it over to Winnie.
Hello, thanks, Grace. So actually, under this high inflationary period, we still have solution for investors to counter off this effect. So we can see for action 1, is the real asset option. So real asset meaning physical asset, which can bring us stable cash flow stream. Popular choice risk is one of them. As you can see in the chart, the total return for risk counting both price return and income returns both outperform S&P when the CPI hits about 2.5%. So the next slide. On a relative basis, we can see that risk outperformed the 60-40 portfolio during high inflationary periods as well. And then for the next action, the action 2, that is relevant to the income-oriented strategies, meaning we invest in stocks or equities which can bring us high cash flow stream. If you on a cumulative basis, counting all the dividend by S&P, and then we invest them. As you can see in the chart, for over 100 years, you can see the total return is explained by price return and dividend return. And dividend return explains almost 2/3 of the total return. So for the next slide, so how high is the yield will be considered high dividends stock, right? So that's a bit of arbitrary, but basically we say anything about 5% or 6% will be considered as a dividend-rich stock. However, when we compare to risk against the dividend stock, the current Singapore REITs are offering a more attractive yield when compared to the US dividend stocks. You can see from the chart, most of them are offering an average of 6.3%. And for this yield, this is also nearly double of that compared to the STI index. And then we also have several blocks mentioning the income strategy. You can see the blocks there, so you're all welcome to look further into our website. For the action fee, the next slide, diversification. That means we go beyond 60-40 allocation. 60-40 meaning that 60% invested in US equity and 40% invested in US Treasury, right? And then this diversification means we will adding exposure in commodity, FX currency, international equities. So you can see from this chart over 15 years, you can be quite sure guaranteeing that if you have a diversified portfolio, then at least you can get a medium return over the years. That's not too bad. And so for the last action, while we can see that many investors are always try to take the market rate for the best timing to invest. So for the current situation, holding cash would be a good option because we see that the Fed fund rate has been quite high, and then the ending rate could be up to 4 or 4.5%. So money market product could be another option for investors. And then for the private equity space, there's that will be a more market for the professional investors in Hong Kong or accredited investors for Singapore. So that one will have more investor criteria limitation or restriction, but they will be more having exposure to the high growth period.
All right. Thanks, Grace and Vinny. I think great coverage in terms of what's happening with the macro environment, as well as some actionables for clients to potentially consider, including use of real assets, diversification, cash management, and other solutions and all. And more importantly, income-oriented strategies in the current environment would be very interesting. At this point, I want to just quickly cover some of the portfolio offerings that SAIF has as part of its product suite, so that everyone is kind of aligned in terms of what we have to offer as part of your investment journey, and how can you use SAIF to potentially address some of these investment opportunities as well. So if you go on to the next slide. So I will refer to both Singapore and Hong Kong, cognizant of the fact that we might have some people joining in from Hong Kong too. So for Singapore, we have a full suite of offering, right? We have our wealth offering, and within wealth, you have our core and satellite investment strategies. The core strategy is more to kind of give you that globally diversified exposure. And these are portfolios that you use to grow your wealth towards your most important financial goals. And you have choices of different kind of equity bond allocations, right? So this is typically the place where most of the people begin their journey. And if you're looking to work towards any of your goals, then it provides you that mix of equity, bond, gold. And depending on your investment time horizon and risk appetite, you can decide whether you want to have a more equity-oriented portfolio or a more balanced kind of a portfolio as well. Then on top of the core portfolios, we have some of our satellite portfolios where people use, for example, our REITs portfolio, very, very popular, uses the Singapore REITs as components, right? We track the index called iEdge REIT Leaders Index. And through this, people are able to enjoy very high dividend yields. So in the context of income strategies, this could be relevant as point of our discussions as well. And again, this has been a very, very popular strategy for investors, especially in Singapore, given the low interests that you get in the banks. And then there are not too many options available from an income standpoint. We also have some thematic portfolios, and these are to kind of capture the evolving mega trends that are kind of shaping our future. And these include things like, what is of value to you, right? Like ESG and clean energy, something that people are now caring much more about, and they want to align their investments to their values. So that could be a pretty important aspect that you want to incorporate as part of your investments. There is healthcare innovation, disruptive technology. You want to take, specific views on countries. You can do that through China growth portfolio. And then we also have a global income portfolio available. Obviously, some of these thematic portfolios also come with higher risks. So again, we don't advise clients to take, concentrated positions into these portfolios, but use them as satellites. So that's why it is categorized as a satellite investment strategy. On top of that, we have our custom builders. So, if you believe you can create your own kind of portfolio, combining core and thematics and other things, you have that choice available where you can choose from over now, I think close to 150 best-in-class ETFs and construct a portfolio to your liking, right? And decide your own allocations. We also have our Cash Plus portfolio. This has been a safe haven for a lot of investors who want to, insulate themselves from the market volatility. So 1.9% projected returns, no lockups, no limits, no tiers. So very important to note the no lockup. Of course, there are now a few instruments available in the market that might give you a higher projected return, but they will always have some, limitations to it, either in terms of the maximum amount of money that you can put, or your money is locked up for a certain amount of time. With our Cash Plus solution, you get a pretty decent yield. And as interest rates go up, the projected return of your cash portfolio also keeps going up, right? So that's that. And then we also have something for our more DIY or people who want to use us as an execution platform. So you have the trading platform through which you can buy US stocks and ETFs. So this is the full suite in the Singapore platform. If you go on to the next slide, it covers what we offer in Hong Kong right now. So in Hong Kong, we right now offer only the wealth sort of platform. And within that, we have the core and the thematic portfolios, right? So again, the intent is to get people to kickstart their journey and do so in mind, taking in mind what are their core financial goals. And that's where the core portfolios fit in very well. And then they can layer those core portfolios with thematic portfolio offerings as well. So those are the two offerings that we have already incorporated for our Hong Kong clients. Now, of course, over time, we will build it up, and you will see the same suite of portfolios and product offerings that we have in Singapore will come in Hong Kong as well. If we go on to the next slide, it I think covers a little bit more about investment strategy, something that we espouse a lot. We believe that the bulk of your money should be invested in index-oriented strategies in a low-cost manner, and with ETFs and index tracking funds as building blocks. And that's why the SAIF core portfolios could fit in pretty well, because these are portfolios constructed using ETFs. They are broadly passive in nature, but we enhance them using smart beta factors as well. On top of that, then you can layer these satellite strategies. So whether you're building your own custom portfolio, or you want to take exposure to certain themes, or you want to build a passive income through our REITs portfolio, or you want to DIY into certain individual securities or certain specific sectors, those are things that are possible via the trade platform too. So again, I think our intent is to give you that one-stop holistic platform through which you can invest the way you like. But at the same time, we are also trying to guide you as to how you should be thinking about your investments in the first place. And that's where I think it is important to have a very solid core, make sure you're analyzing your risk very, very well, because, through the last 2 years, a lot of investors had piled into very high growth oriented investments, which obviously did pretty well in the post-pandemic era. But come 2022, people are seeing drawdowns more than 30, 40, 50%, which kind of brings back to the reality that essentially you should be diversified first, manage your risk first, build portfolios with a more passive approach to begin with, and then think about these additional layers which can give you additional returns. All right, if we go on to the next section, I think so that's mostly all the things that I had to cover for our portfolios and product suite. I will hand it over back to Grace to kind of go through a fireside chat where we will cover some of the most important questions that might be burning inside a lot of the joiners today. And hopefully we should be able to do justice in terms of thinking through how you could address those.
Yeah, before we do that, if you could just pull up the last poll. So that's covering, just wanted to take a poll to see where people are in terms of what have they added to their portfolio this year. So, added, I think it also means like if you reduce the allocation to, right? And then if you sort of liquidate a portion to cash, right? That also means that you add it to cash. So, but there are of course others as well, but so you can choose more than one option in this case. So what have you added to your portfolio this year? Cash, real assets or inflation hedges, income-oriented strategies, have you sort of just stuck to the plan, or have you been buying the dip? In some cases, I think if you did it back in June, right? And then you sort of would have gained almost 20% before the most recent drop again. Yes, and if you guys have more questions, please send them in, and we definitely want to address that. Okay, consider responses. All right, okay, so interesting that the most popular response has been to stick to the plan, followed by cash and anything that generates an income. Okay, great.
Very interesting, I think.
And good to know, yes. Right, if we can just go into the question one of fireside chat. Thank you. So what needs to change, right, for the negative correlation between bonds and equities to reassert itself? Maybe I can go first, and then Winnie can also add anything if you'd like. Yeah, so I think generally it just sort of need inflation to come down, and not just to come down from maybe 8% to like 6%, but to sort of to show that trend has been coming down in a very consistent way, and then for the Fed to be like, okay, we've done enough in terms of raising interest rates, and we'll sort of go back to like the long-term average rate of what they've been targeting around like 2.5%, and then they can also be convinced that okay, then our interest rate policy is also appropriate. So I think unless there has been kind of consistent evidence of that price stability, it would be tough for any for us to sort of see that negative correlation of the bonds to sort of be that very effective buffer against equity volatility in the short term, at least. Yeah, Winnie, do you have anything to add?
Somehow I agree with Grace, and on top of this inflation, I think another key indicator will be the quantitative tightening plan by Fed. So this will affect the overall liquidity in the market, which is quite sensitive for bond as well. So if they are being more aggressive for the tightening and the exit plan, I guess the correlation will still be positive for both bond and equities.
Okay, thanks, Winnie. All right, so moving on to the second question, which I think is also relevant to a question that we got from the audience. And maybe I can start the question from the audience first, and that is, why don't we have a Straits Times Index ETF in your portfolio, for people who do want to invest locally? And the answer to that is, I think stay tuned. We will be announcing yeah, sort of a new offering, or not really a new offering, but sort of the ability to trade local stocks too in the next month or so. All right, but this question is, I think we have seen like Singapore being quite resilient, both for equities, so Singapore stocks, but also for Singapore REITs, relatively stable, resilient, despite what's happening globally. So with S&P 500 down almost 20%, right? For Singapore, it's been mostly flat, if not slightly positive. And I think the reason for this is that firstly, the market structure is quite different in Singapore as compared to the US. The sort of investor base again is also quite different. I think a good amount of both institutional and retail investors tend to like not trade as often. So there is this mentality of like sort of buying and holding a lot of these very popular stocks that are also in the STI Straits Times Index, which have been relatively stable, right? And then they pay dividends. I think for REITs, the story is a little bit different there because they just have suffered quite a bit since the pandemic, right, in 2020. And then in 2021, there has been some recovery, but then with what's happening now with the global like reopening, there's a bit of like revenge travel going on. I think, if you look at so we are hosting F1 next week, and then all the hotels, right? I think a lot of the ones that are near the circuit are almost like $2,000. So that's for hospitality overall. Like hotel occupancy has been increasing, but different sectors like office, for example, which tend to have a higher yield, as well as retail, right? So a lot of the incoming leases have been higher than outgoing leases. So you do have that stability and that inflationary hedge for real estate, because they're also, for the REITs, they have required to pay 90% of the income. They have to pay it out to investors. So I think that's mostly why it's been relatively resilient. And I think for a lot of these REIT managers, right, like they sort of saw this coming, that interest rates will be going up. So they do have a plan in place, which they also did in 2016, which is to think about hedging their interest rate risk, right? So that could mean that for the debt that they own, right, to have as much fixed rate as possible. That's one. And then for the ones that they don't have an ability to do that, they will do like a fixed, a floating to fixed swap, for example, just to limit that volatility. But of course, as interest rates go up, right, that's not, so what they can do is still limited because, overall their borrowing cost is still going to increase, but, in terms of preparing and doing what they can, I think they've done, a relatively good job in terms of preparing. Okay, if I can go to the next question, right? And that's for question 3, how much progress do you think the Fed has made in taming inflation, and how much more work do you think they will need to do? Yeah, we need to start with that first.
Sure, I think for Fed, there's not too much they have done for the inflation thing. It's because we understand that the inflation now is a supply side issue. So mostly the energy prices, the food supply has been troubled a lot by the Ukraine-Russia situation, which is not likely solvable in the coming 6 months. And also we can see that the labor market in US is in very much shortage. So not much work Fed can do on the inflation. So now we can see that they keep adding the rate, so they want to lower down the demand side until it proven that they can slow down the demand side, or else the CPI will remain high level for a while.
Sorry, I'll mute. Yeah, thank you, Winnie. And I think this is a sort of follow-up question from the audience, like when will the Fed stop raising interest rates? Yeah, so I mean, I would, for anyone else who's curious about this, I would highly recommend the press conference that Jerome Powell holds after each FOMC meeting. I think it really helps to sort of understand, right, like what they're trying to go for, like, what do they see their mandate as, and also what do they think is actually achievable. Right, so I think first, inflationary pressures are diminishing, right? So not as fast as the Fed would have liked. because there are some sticky factors like wage inflation, right, due to the strong labor market that Winnie has mentioned. You still have inflationary expectations. And then the biggest component, which is shelter. So that's, like rent, that's still, they're still rising, right? Similar to, I think, Singapore, right? So you've seen that in most developed economies. And secondly, right, there are these reasons where you sort of see like there are a lot of expectations on the Fed to do something. But the thing is, a lot of the action, so the Fed can pretty much do two things, right? And they're relatively blunt tools, which are they can increase interest rates and they can do quantitative easing, right? And then these two things, they do take some time to sort of percolate through the economy. And investors, I think, would be helpful to sort of distinguish between what the Fed can do, and that includes like what they should do and what's actually achievable, and a more reasonable sort of expectation of the Fed. I think that suggests like a better outlook for financial markets and in the economy as a whole. But to sort of answer the question a bit more directly, when would they stop raising interest rates? I think it's when they see data coming in, and data does have a lag, that price stability is relatively consistent. Okay, I think the next question is a very good segue into one of the audience questions, and that is, for someone who's looking to invest $20,000 now, what would you tell them? I think I'll give this to. Oh, sorry, can you change the slide to question 4? Yeah, perhaps Pritesh can answer this because I think he and his team would get something like that quite often. But also to contextualize this a bit better is that we got a question about someone saying that I'm 31 years old and I'm saving for my retirement. Does this mean that I should abandon bonds entirely and just hold 100% equity portfolio? Yeah, over to you, Ritesh.
Thanks, Grace. And I think some really, really good questions coming up. So we should try and address as many of them as possible. And I think very relevant as well, because people are, again, I think, scratching their heads right now, because even a defensive portfolio, which is supposed to be, defensive, is maybe losing similar, if not more, than an equity portfolio, right? So I understand, a lot of investors, what's going on in your mind. But again, I think this is just a different year where both bonds and equities have been, same correlated, right? Similarly correlated rather than oppositely correlated. This was the first slide that we had in today's session. And because of that, I think investors are not getting that diversification benefit in the first place. So what can you do, to get over it? See, I think in general, if you've got, a certain amount of corpus with you, your starting point obviously is to kind of map out what is your goal, right? Like if it is a retirement goal, which is say 20 years, 30 years down the line, yes, I do suppose you can have a more growth-oriented profile, and which means basically a more equity-tilted portfolio. Now, that does not mean that you will have, great returns year 1, year 2, guaranteed, because equities do have much more volatility embedded within them. And what that means is you should be ready to go through the ups and downs of the equity market if you, only have equity as your portfolio. Now, a lot of investors, when I speak to them, they say that, yes, I have 20 years, 30 years of time horizons. This gentleman who's 31, potentially you have 30 plus years of time horizon. But are you okay, with a situation where maybe the, stock market remains negative for a few years? And we will cover that, I think, as part of the next question as well. But, the stock market can be negative for prolonged periods. And the amount of negative can also be something that you can then be perturbed about. So you really need to map out what is your investment, not just the time horizon, but also your own risk appetite. That is, I think, the fundamental aspect of how you decide to allocate. Now, typically the starting points of someone to create a portfolio and have risk management embedded within their portfolio, you pair equities with bonds, right? And obviously that has not worked that well for this year, but in the longer context of investing, usually equities and bonds are oppositely correlated, so that should work. So your starting point should always be, when you have an equity-oriented growth portfolio, add some bonds to kind of diversify away your risk. Now, in the new context of high inflation, there could be other ways that can complement your 60-40 portfolio. So maybe, start with a certain allocation between equity and bond. If you have a longer time horizon and a higher risk appetite, maybe you don't have 60-40, but a more equity tilted kind of equity bond portfolio. And that is what we saw in one of the polls as well. People are actually generally more equity tilted. And I suppose that's because of the average age of our audience must be on the younger side. So they have, higher risk appetite. Once you have sorted that out, then you should look at other kind of instruments that can help you kind of, again, further diversify as well as hedge risks, right? So typically commodities like gold and other such asset classes could be good for you to complement and add to your portfolio, which can help you in navigating these situations better. In the current context, for example, you can see other alternatives, from just commodity, which is gold, to commodities, which is like energy, commodities, which are like, actual agri, related commodities and all as well. So these are all things that can help in kind of further diversifying your risk. But again, I think you need to be prudent about it as well in terms of like, what you're adding and, are you expert? Do you have that expertise to kind of add the requisite amount and add it at the right time and remove it at the right time? So those are things that you need to kind of worry about. If you don't have that expertise, you can start with like one of our core portfolios, which have that equity bond gold kind of components, and then layer it with some of these other things through, say, our custom portfolio offerings or trade offerings as well. On top of that, I think going by the theme of income in the current context, while fixed income obviously has suffered, instruments or vehicles such as REITs could be a great diversification angle. And especially in the Singapore context, it is a bit more insulated to what is happening around the world. And real estate and REITs, for example, as inflation goes up, usually people worry that inflation goes up, interest rate goes up, REITs will suffer because they also borrow money, right? But if inflation is going up, but there is still decent growth, which is true in the case of Singapore, REITs tend to do much better. So from that kind of perspective, if you can complement your equity bond portfolio with, allocations or exposures to REITs, exposure to, some commodities going beyond gold, that I think could be helpful in terms of, navigating through this current situation a bit more better, right? But I think the fundamental thing still is, make sure you align your risk things much, much better. Even if you want to invest, for example, into the, mega trends and high growth kind of instruments, you should be ready to kind of see negatives and prolonged periods of negatives and, pretty sustained drawdowns. As long as you are able to do that over the longer term, taking more risk means you should be compensated in terms of returns for those risks as well, right? But my observation again is that most of the people are not cognizant of their own risk appetite to begin with.
Or actually have a slide showing the portfolio allocation that Ritesh mentioned, so we can just flash that very quickly, right? Where you sort of still do have a very like globally diversified, equity heavy, but still a small portion of bonds, right? For that buffer, and then complementing that with REITs that generates income, and also potentially for cash, right? If you're thinking of deploying that cash and you're sort of just wanting to earn a bit more than what you currently would get in a bank account, I think that's something that we've set up here as just like a sample, like indicative size. And then for the one more question, perhaps, I think this is also quite similar to what someone has asked, like, should I change my strategy? But for question 5, the last one is that, for someone who started investing in 2021, right? So close to the peak, what are some things that they can do, right? And what are some sort of important lessons that they can keep in mind as, it's tough always to kind of see your portfolio value go down.
Right. So again, I think, want to contextualize as to what has happened in the last 1 year versus if you go back in history. So if you go, just the last 1 year, the average drawdown that we have seen in the market is close to 21%, right? Like, 1 year, if you look at the returns in the equity markets, it's close to 21%. And that's assuming you're investing into a broad-based like S&P 500 kind of an index. If you're investing into more concentrated sectors, your losses could be much higher. Especially in like, again, very high growth sectors. So for example, S&P 500 year to date is like close to 20% down now. But if you look at NASDAQ 100, which is the more growth index, is close to 26, 27% down. It almost touched 30% down in the months of, I think, July. But now it is close to 27% down still. So obviously that begs that question that, like, what do we do now and what's the kind of way forward? I would actually go back to one of your slides, Grace, I think slide 18. If we can just go back there, I think there are some very important life lessons to be learned. So if we go back, slide 18, I think, yes. Yes, all right. So look, if you are investing for your long-term goals, these corrections should not be, should not be hindering you from that goal or that path. Now, if you go back to, say, if you are an unlucky investor and you started investing at the peak of, the tech crisis that happened in 2000, right? So you see that lost decade part of this particular chart, 2000 to 2010. If you started investing in 2000, you would have not seen a positive return for almost 8 years. Like, you would have seen barely a positive year coming into 2008. And then again, there is a big financial crisis and there is a 60% markdown, right? So 2008, you go through another 60% markdown, and it takes almost another 4 years, 2012, for you to go back to even. So someone who started investing at the peak of the market in 2000, has not seen positive returns for 12 years, right? So that's like just really, really painful for us as individual investors to go through. But the important point is these kind of situations happen, and they happen all the time, right? Like, you have another example in the 1970s where you've, sort of had very flat returns for a very prolonged period of time. The only advice that I have is to keep with your goal, right? Like, don't get panicked, DCA, add as you can, buy into the dip, but also reassess. These are important points for you to reassess your risk, right? Like, if you don't think you have that risk appetite to go through a 60%, 50% kind of a decline that happened in the, financial crisis, you should not be investing into a 100% equity portfolio, or you should not be investing into a very thematic concentrated portfolio in the first place. So these are important considerations, learnings that you should have. In my opinion, almost 70-80% of your money should be invested in a very broad-based manner in core portfolios that are globally diversified across asset classes. That should be the starting point. And if you do that, it doesn't matter when you entered into the market, because even if you did enter into the market in 2000, if you're planning for your retirement and you were 31 in 2000, think where you are going to be if you are in 2022. That's 22 years. So of course you saw 12 years of negative returns if you're only equity investor. So, I think there was this question, can I only invest into equity? You can go through that as a, investor, even if you invest 100% equity thinking that will give you great returns, but 12 years of negative returns. But if you remain invested, what you see is even with that, the patience of remaining invested gives you that returns in the long term. In 2022, I think you will be still high single digits in terms of returns, so between 5 to 10%, which is not bad, right? Like, it definitely does beat inflation. But if you remain invested for even longer periods of time, the returns just keep compounding, right? So in my opinion, right now, yes, of course, things look tough, but in context of what's happened previously, it's only a 21% decline. So there might be more pain to come. But again, what I would advise everyone is to look at how you're investing right now, think of ways how you can further diversify. If you don't know how to, kind of get through these, speak to an advisor, like speak to one of ours, right? And we'll be happy to guide you.
Yeah, thank you, Ritesh. All right, if I could just take a few more questions from the audience. So like some of these get a bit more specific. So we all start with Collins, and that is, how does dividend withholding tax get factored in? So Colin, I assume you're talking about US stocks and ETFs, right? So that, there would be a tax of 30%. But for, for a REIT Plus offering, because it is of Singapore REITs, right? And I'm assuming that you are also based here. So that would mean that, there's no withholding tax, right? So the yield, sort of you get pretty much, you get that payout, right? Entirely without that tax burden. And then
Also quickly,
oh,
I think
yes,
we should
go on.
add that point of, while people superficially look at dividend withholding tax as, one of the most important criterion, but the fact is that if you're investing in a more growth oriented, portfolio, usually the dividends are very small component of your return. It's like less than 1% of your return that comes from dividends, and mostly like 80-90% of your returns comes from the price returns or the price appreciation, which means that essentially the dividends contribution is much lower on the first place. The second thing is, to solve the dividend withholding tax, usually you will have to move from US domiciled sort of funds to Irish domiciled funds. Now that can save you maybe around 15% of dividend withholding tax, but there are other implications that you might not be aware of. The US domiciled funds typically tend to be less in terms of expense ratios. They tend to be much more liquid, and they have less bid offer spread, and they track the index much more better. So whatever savings that you get in the Irish domicile can be eroded away because of these other factors. And that's why I think like we have these dividend withholding tax related aspects factored into our portfolios. For example, in our core portfolios, the S&P 500 exposure is actually through Irish domiciled ETF. So that is where we felt that the trade-off is such that the Irish domicile makes much more sense. But there are the other ETFs where the trade-off is not that great. We are better off using a US ETF. So again, be cognizant of the overall implication rather than just focusing on dividend withholding tax.
Okay, yeah, thank you. All right, so the next one is about bonds, and it's from Jay. So are there markets, like geographical regions, where bonds have not suffered as much as they have in the US? And if so, like what's the outlook for bonds in these regions? Yeah, maybe I can take that. So the reason why for most of the world, right, that bonds have had a tough time, and that's because of interest rate hikes, right? And then if you look at, I think there was this chart of this world map of all the countries that have been increasing their interest rates. So it's pretty much every developed economy and maybe at least 75% of emerging market economies have done that, with the exception of China. So China, because of they're trying to be very supportive and accommodative of, hoping to get to at least 5% growth for this year, but also to support the real estate sector that, it's sort of like borrowing cost equivalent, or the equivalent of like Fed funds rate, not really the same, but sort of that. If we were to look at one rate in China, that has been slowly coming down, and then financial conditions have been kept loose quite deliberately. But the flip side is that because we are, we're sort of coming in as like a foreign investor, and it's that because China's monetary policy is relatively looser, so overall, like the bonds have done pretty well, right? If you look at just total return, but because of that looser monetary policy, relatively, is that the Chinese currency has deteriorated. So even though you're getting like a positive return for income, and in some cases a positive return on, or a stable return on price, that gives you the overall total return. But if you take currency into account, right, that sort of that negates some of that gain that you make on just like purely taking on like fixed income risk. Yeah, so in a way, I think because of what's happening right now, there is like really no place to hide in that sense, maybe except for any like cash related, so very, very, very short term, and you're sort of just buying these bonds, or like I think what many Singaporeans have done is to like hold more of these like SSBs, like try to get a larger allocation there. So I think that you do have that certainty, and you also have that that stability. But the thing is, you also don't really have growth, right? I think it might be a good idea for like a very short term, right? Sort of less than 1 year. But if you think of returns over the next 10 years, right? Is SSB going to be, or I mean, not SSB in particular, but just an instrument that's like that, right? That savings has like locked in. Is that going to be where you can generate the most return? I think the answer there is a lot less certain. Yeah, so I mean, to sort of summarize, it has been tough overall, but then as a tool for for portfolio diversification and portfolio construction, right? We still think that, you know, as inflation comes down, we do see that negative correlation reasserting itself between equities and bonds. Okay, I think we are we're over time.
Grace,
but-
maybe like, you know, we'll just quickly take
Yeah.
all of these questions in one go because we are running out of time. And then, you know, please, like, you know, if you guys are we're not able to answer all of them, please do reach out to us, the advisory team, and we'll be happy to take them separately as well. But just quickly running through, does SAIF offer factor portfolios? So our core portfolios do have factors incorporated. So this is a question by Wilson. So do, you know, look out for, you know, how we incorporate these factors. Happy to, again, walk you through in a much more deeper sense. There is an investment strategy page that we have launched. So that kind of explains pretty well how we have incorporated factors into our portfolios. Does SAIF plan to offer income-oriented portfolios? I think so. We are looking into it. This is, you know, something that we are actively exploring. Grace is, you know, working on a solution which hopefully can give you that. In terms of our portfolios, I guess, like, you know, capital, one of the attendees is invested into capital growth and has double-digit negative returns, and even REITs is partially negative. So how could I help to bring both funds from negative to positive returns going forward by end of the year? So look, I mean, hard to say whether that will be possible by the end of the year or not. But I think one thing that you can control is, you know, make sure that you're investing regularly, buying through these dips. And eventually, as we, you know, covered earlier as well, that should translate into better returns as we move forward. So I think stick to your plan. That's the best that you can do. Control your risk, diversify. And if you do that, then overall, you should be fine in the long term. For passive income, this is actually a great kind of suggestion that is coming in from, I think, Welkers, if I'm not mistaken. For passive income in the REIT Plus portfolio, we pay out on a quarterly basis. There is a suggestion that can the dividends be paid out every time the REITs actually pay out the dividend, or at least it can be controlled by the users when they can take the dividends out and all. So that's a great suggestion, Welkers. We are looking into making this process a bit more efficient, but it might not be, you know, immediate that we'll be able to come out with a solution yet. But yes, I mean, we are looking at making this process a bit more efficient for our users. So please stay tuned. And thank you for the feedback. All right, Grace, over to you. Any others?
Yeah.
Otherwise, we'll...
Yes, I think that's all the questions that we have. Yeah, so thank you everyone for staying till the end and letting us sort of get through all the questions. But of course, you know, if you have anything further, do reach out to the advisory team. So you can do it through the app, or you can schedule a consultation call with any of the advisors. But yeah, also, you know, we welcome the feedback and on income portfolios, as well as, you know, having that dividend payout flexibility for REITs. And yes, yeah, please have a good evening, and then do reach out if you have any more questions.
Thanks, everyone. Bye-bye.
Bye.